Most people remember the 1980s for flashy markets, Wall Street greed, stock booms, power suits, and excess. That image is incomplete, because beneath the surface, the 1980s were not an era of prosperity. They were an era of financial restructuring, quiet crises, debt traps, systemic experiments, and the consequences of those decisions still controlled the global economy today. The 1980s were not just a decade, they were a reset. Before the 1980s, the world still lived in the shadow of Bretton Woods. Currencies were loosely disciplined, capital controls existed, governments intervened directly in markets. Money was imperfect, but it was restrained. That restraint ended in the 1970s, and the shock arrived in the 1980s. The first fracture was inflation. During the 1970s, oil shocks and war spending flooded economies with excess money. Prices surged, currencies weakened, trust eroded. Governments responded the only way they knew how: print more, borrow more, delay the pain. By the late 1970s, inflation was out of control. The system was breaking. In 1979, the response came, and it was brutal. The US Federal Reserve raised interest rates aggressively, not gradually, violently. Rates crossed 20%. This decision is often portrayed as necessary medicine. It was, but it was also a weapon. High interest rates crushed inflation. They also crushed everything else. Businesses collapsed, unemployment surged, debt became lethal, and the effects were not confined to the United States, because the world had already been tied to the dollar. Developing nations had borrowed heavily during the 1970s. Cheap dollars, floating rates, optimism. When rates spiked, debt servicing exploded. Overnight, manageable loans became impossible burdens. This is where the global crisis truly began. In 1982, Mexico defaulted. This was not a local failure. It was a signal. Latin America followed. Brazil, Argentina, Chile. Entire regions collapsed under debt. This became known as the Latin American debt crisis. But the name hides the truth. This was not mismanagement. This was systemic exposure. Loans had been encouraged, even promoted. Banks recycled petrodollars into developing economies. Everyone benefited until rates rose. Then responsibility vanished. The solution was not forgiveness. It was control. The IMF and World Bank stepped in, not with aid, with conditions. Structural adjustment programs were introduced. Cut spending, privatize assets, open markets, reduce subsidies. These were not economic suggestions. They were requirements. Countries surrendered policy autonomy in exchange for liquidity. Debt became leverage. The result was stability on paper and devastation on the ground. Social services collapsed. Public employment shrank. Poverty surged. But creditors were paid. That was the priority. This was the moment global finance changed. Money stopped serving development and started enforcing compliance. At the same time, the United States faced its own crisis, the savings and loan crisis. Thousands of small banks collapsed. Why? Because deregulation encouraged risk without oversight. Institutions gambled with depositors' money. When rates rose, the system imploded. Taxpayers paid the bill, privatized gains, socialized losses. A familiar pattern. This was not an accident. It was a preview. Meanwhile, financial markets were being liberated. Capital controls were removed. Cross-border flows exploded. Speculation replaced production. Money began moving faster than governments, faster than regulation, faster than accountability. The 1980s marked the rise of financialization. Wealth was no longer built primarily by making things, it was built by moving money. Leverage, derivatives, debt instruments. Risk was repackaged and sold as innovation. Governments embraced this shift. Because financial growth looked like real growth, markets rose, indexes climbed, debt expanded invisibly. The illusion was powerful. But financial systems were becoming fragile, highly interconnected, highly leveraged, highly sensitive. Small shocks created massive consequences. Stability depended on confidence, not fundamentals. The 1987 stock market crash exposed this fragility. Markets collapsed in a single day. Black Monday, the response, liquidity injections. Central banks stepped in to stabilize markets. This decision changed everything. From that moment forward, markets learned a lesson. Risk would be absorbed. Losses would be managed. The system would intervene. Moral hazard became policy. The 1980s normalized bailouts, not officially, psychologically. Markets internalized the expectation of rescue. Risk-taking accelerated. This was the birth of the modern crisis cycle. Debt-fueled growth, asset inflation, systemic risk, central bank intervention. Repeat. Globally, the damage compounded. Africa fell into debt dependency. Latin America lost a decade of growth. Eastern Europe destabilized. The winners were not nations, they were institutions, banks, funds, financial intermediaries. Power shifted from governments to markets, from production to finance, from sovereignty to dependency. By the end of the 1980s, the world economy looked stable. Inflation was controlled. Markets were booming. Growth returned, but the foundation had changed. Debt levels were higher. Inequality had widened. Financial systems were fragile. Stability was purchased with vulnerability. The crises of the 1990s followed naturally. Asia, Russia, .com, then 2008, then everything after. None of this was new. It was all engineered in the 1980s. The 1980s taught the system a dangerous lesson, that crises could be managed, that debt could be rolled, that intervention could prevent collapse. But it also taught markets something else. That risk had upside with limited downside. This imbalance defines modern finance. Privatize profits, absorb losses. The system did not collapse, it mutated. History remembers the 1980s as a decade of recovery. It was not. It was a decade of redesign. The global economy did not heal. It transformed. Debt became permanent. Crises became cyclical. Stability became artificial. The most important shift was psychological. Markets stopped fearing collapse. They started expecting rescue. That expectation is the real legacy of the 1980s. This is why modern crises feel familiar, because they are iterations, not surprises. The 1980s exposed a truth most people never learn. Financial systems do not collapse suddenly. They are reprogrammed through crises. Each crisis transfers power. Each response reshapes incentives. The decade did not destroy capitalism. It financialized it. And financialized systems are efficient until they are not. The 1980s were the moment money stopped being a tool and became the system itself. This is not conspiracy. It is documented history. Interest rates, debt contracts, policy decisions, all visible, all ignored. If you want to understand today's instability, you don't start with 2008. You start with the 1980s because that is when the rules changed. The crisis was not a failure, it was a transition. And transitions leave scars. The 1980s were not about greed, they were about control. Control through debt, through liquidity, through policy alignment. The world learned how to manage collapse without fixing causes, and that knowledge reshaped everything. This is why crises now feel endless, because the system was designed to survive them, not to prevent them. The 1980s did not break the global economy. They taught it how to live permanently on the edge. If this video woke you up, drop a like and subscribe. New forbidden truth every single day. Turn on notifications, the next one might save your wealth. Comment the one thing you're doing right now to prepare. I read every single one.